In this week's On the Tape, I welcome Ivy Zelman back to the pod. Ivy was on here earlier this year in late March. While much has changed on the macro as it relates to housing when looking at rates, underlying trends continue to be stagnant, and we get into why that is. For those not familiar with Ivy, she has been covering the housing industry for decades through many cycles, including the GFC, and is widely considered the best analyst in the housing industry. We get Ivy's latest thoughts on the trends she's picking up from her surveys, why she expects home prices to be down in both 2025 and 2026, the impact of government policy and potential housing reforms, including Fannie and Freddie, troubling delinquency trends in lower-end consumer housing, and what a true economic slowdown could mean to the sector, and why she thinks investors are too optimistic when it comes to manufactured housing. But before we get to Ivy, and as we continue into earnings, I wanted to bring up something I actually discussed on that same Ivy episode in March, and that was how Kalshi was beginning to become a real threat to the online gambling incumbents such as DraftKings and FanDuel. Kalshi had just partnered with Robinhood to begin offering event contracts during NCAA basketball tournament, otherwise known as March Madness, and to me, that truly was the coming out party. Since then, we have seen plenty of activity in the sector, including partnerships such as CME and FanDuel partnering for non-sports event contracts, although sports appears to be on the horizon, Polymarket's re-entering into the U.S., and then a $2 billion investment from ICE, owner of New York Stock Exchange, at over a $9 billion post-money valuation, Kalshi raising capital at $5 billion valuation, Kalshi and Polymarket partnering with the NHL, Crypto.com partnering with Underdog and the likes of Hollywood News for entertainment-focused prediction markets, DraftKings buying prediction market platform company Railbird for non-sports events. Then you have betting scandals in the NBA involving current players and coaches, which only puts more pressure on the state licensed gambling incumbents related to player props. While the initial sports events Kalshi was offering were limited to game outcomes, their offerings have since evolved to include parlays as well as spreads, which compete directly with DraftKings and FanDuel. The result is a continued assault on higher margin offerings, including in-game live wagering from the likes of DraftKings and FanDuel. While current market share gains may be small, they are accelerating. And with the blessing of the CFTC and both CME and ICE diving headfirst into the prediction markets, we will continue to see a first mover advantage for the prediction market players in states where there is no legal online gambling, and a market share gains from the incumbents in states where they are currently operating. Look no further than the stock prices of both DraftKings and Flutter, parent of FanDuel, and we should get some more color when DraftKings reports after market closes this Thursday. Sticking with prediction markets and sports, on to Week 10 in the NFL. Before I get to the NFL picks, just to recap the horse action in the Breeders' Cup, in quite a weekend for Japanese athletes. Dodgers, led by Ohtani, Yamamoto, and Sasaki, won the World Series, and the first ever Japanese horse to win the Breeders' Cup Classic, Forever Young. My pick, Sierra Leone, finished second, and you made a little bit money if you bet them across the board, but Forever Young ruined the exactas and trifectas. Okay, on to the NFL. My record is now 11-11-1. I can't seem to get stuck out of this 500. 2 picks this week. Every once in a while, a game comes along and the spread makes no sense. Normally, that's a sign you are missing something, like in a stock. Well, I'm having a hard time this week understanding how the Philadelphia Eagles are 2.5-point underdogs at Green Bay this week. I'm sure people expect a bounce back from Green Bay after they lost to Carolina, but they lost Tucker Kraft, one of the best players on the team, tight end. He tore his ACL, and they still have lots of injuries. The Eagles are coming off of a bye week and not only getting healthier by the week, but made several trades that have now enhanced their defense. And I will give you this. The Eagles under Sirianni as coach are 6-0 in the regular season following a bye week. Give me the Eagles and the 2.5 points on Monday night in Green Bay. The other game is also a night game, going back to the Steelers on Sunday night. They're playing at the Chargers. Steelers defense is looking better and better. Chargers just can't seem to stay consistent, and they have major injuries, including their all-pro left tackle Joe Alt, who's out for the year. They'd already lost their right tackle. Technically, this is a road game for the Steelers, but I think SoFi Stadium will have many Steelers fans in there. Give me the Steelers plus 3.5 on Sunday night. It's a true pleasure to welcome Ivy Zelman, founder of Zelman Associates, back to the pod. And for those of you not familiar with Ivy, she's unequivocally the best housing analyst of all time and has had a storied career, including early calls on asbestos being a liability for many building product manufacturers, identifying housing issues ahead of the GFC, and as Michael Lewis said in The Big Short, all roads lead to Ivy. Ivy, I hope that doesn't put too much pressure on you for this interview, and it's great to have you back.
Thank you. It was very kind. Appreciate it.
All right. You were last on the pod in late March 2025, kind of in the middle of spring selling season. which turned out to be slightly disappointing. And while things kind of picked up in the summer, we've had rate cuts and a lower 10-year yield. You would think things would be accelerating, but give us your kind of current view of where things kind of stand in the housing markets.
Slightly better. I think that the affordability challenges remain prevalent. And I think even with rates coming down a bit, volume, while demand is good, it's at a value that really is how people execute. So today, builders are still aggressively incentivizing. They're getting absorptions, but their margins are under pressure. They're pushing back on vendors. They don't want price increases on anything. So it's a challenging environment, but I'd say demand is not bad, but I think consumers are really looking for deals.
So the public builders have massive economies of scale advantages. You've pointed out they can absorb the tariffs. They're probably pushing out a lot of the private builders, buying down mortgage rates. As you said, do you see that trend continuing here?
It's a vicious cycle because builders that are trying to offer incentives, mortgage rate buy downs, about 70+% utilize a mortgage rate buy down in the public arena. So it's extremely prevalent, predominantly weighted to the entry level at 100%. So it's kind of a drug. It's hard to get off of it. And because they want to offer mortgage rate buy downs, they have to spec because you can't provide a mortgage rate buy down on a build to order. It's too expensive. So it creates this circular challenge of continuing to spec, which means you'll get completed inventory, then you have to discount that inventory to move it. So I don't anticipate them getting off of the drug, so to speak, the mortgage rate buy down. And I think therefore they'll continue to spec. They have pulled back a little bit on starts, but for the most part, even if rates were to come down another 50 basis points, I don't know that we're going to see much of a change. I think we have to see incomes increase, mortgage rates come down, and maybe home prices come down more.
So mortgage spreads are tight, which is a good thing, right? So that's a positive. But I know you pointed out and you just mentioned spec homes as a percentage of new homes on the market are at an all-time high. But we shouldn't be so alarmed at that, to your point, because they can be flexible in closing those things. But they're not buying land as much as you just pointed out. So kind of where are we on that cycle of the new homes getting absorbed into the system? Like what inning are we in that?
I think it's fair to say it's probably late innings, except the fact that I don't know how their business models will allow them to stop it. And we talk about it at length. Many builders will say that it's a real challenge because the salespeople have gotten very comfortable with driving activity through incentivizing. And because of those mortgage rate buy downs really help affordability substantially, people are getting rates as low as 4.99. On completed spec for 30 years, they're getting as low as 3.99. So the problem is that as rates come down, some builders go even further down with buy downs. And so it's really about market share. And while their specs are at all-time highs, as you point out, it's a buyer's market. It's great for the consumer. It's not great for the builders, but they have a real challenge at that entry-level price point. The mid and higher price points are doing much better. And I'd argue in some markets, it's more likely to see even some price appreciation. But that's not the case in many of the markets that were the big COVID winners. Now they're the COVID losers.
So overall, we haven't seen this, I don't know, since GFC maybe, but we're on track, according to your numbers, to have home prices decline 4% overall for this year and then go down another 2% in 26. When was the last time we had negative home prices in back-to-back years? I mean, I looked at your charts. You only go back to 2012, but I assume, was it 08, 09? What time period?
Yeah, and yet, think about it, it's net of incentives. So when we're looking at those price declines, we're including incentives to drive those forecasts. And I think that the builders, despite the challenges that they have, are still driving pretty good absorption. So I think that gives you more of a, optimistic perspective that if rates were to come down even further, if we had improved affordability, I think those factors could help, but it's a grind. And they're very challenged, with the exception, again, it's really a tale of two geographies and a tale of two price points, because it's very different if you're in the Midwest than the Southeast from a geography perspective. And it's very different if you're at the entry level or you're at the high end. So those are the factors that make the business more complex than just saying everybody's hurting, because not everybody is.
We're going to get into the K economy and how it's spilling over into housing. But I want to go back because you do these great surveys. You have survey percentages, too, of the people that you talk to within the particular sector. So you do home builders, building products, mortgage brokers, everything. Give me a quick rundown of what your surveys are telling you. We can kind of complete the...
Sure. So I'd say building products are still seeing real challenges. The home improvement market really hasn't gotten better. They're suffering with tariff cost increases and the difficulty of passing those along while they're going to catch up. Right now, we're seeing a lot of disappointing earnings come to fruition on the top line and on margin. In the mortgage arena, we just had a very strong quarter from Rocket. There's real market share opportunities for them that they're delivering on. But I'd say that it's refis have helped because refis have improved, but the purchase money mortgage market is still a grind. But I'd say that it's really about who has the capital to invest in AI, who has the technology, and that really, hands down, Rocket's the winner. When you look at real estate brokers, they're telling you the tale of two price points, that they're seeing more momentum again at the mid to higher price points and still struggling with entry level, and inventories are still elevated. Again, that though is very much dependent upon what markets you're in, because some of the realtors are still seeing pretty good activity again in those markets where there's a lot of constraint around product availability, and even bidding wars still in certain markets, like in places like Cleveland, where I live, or in Syracuse, or in Chicago, because there's such a limited amount of supply on the market. And contrast that with Naples or Fort Myers, which tend to be the canary in the coal mine right now, where there's so much inventory that prices are under pressure, and you have people sitting on the sidelines going, do I really want to be the idiot that buys right now at the top of the market? Why not just wait or get a deal that's further inland and away from what is clearly a market that's laden with lots of inventory?
So you've had M&A in building products, M&A in mortgage brokers. Are we going to continue to see this type of thing go on? Rocket obviously is involved in a big merger here, but give me the M&A landscape within all of the sectors that you cover within housing.
I think M&A will continue. I know, because we have an investment banking business, that there's a lot of activity of private builders trying to sell. Their cost of capital is significantly higher. They don't have the scale advantages. They're dealing with what they call stupid and silly behavior by the publics with respect to incentivizing through mortgage rate buydowns. So they're really starting to see a ramp up in willing sellers. And they need that volume. The publics want to buy because it's so difficult to grow greenfield or organically. In the mortgage arena, I think it's even more challenging. I think that the scale and capital are really making it challenging for others to compete against those that have that of those aspects. So I'd say further consolidation. I don't know who's left to buy, but there's not that many players out there. But I'm sure the smaller guys are suffering. And we just saw Anywhere sell to Compass, which was a big transaction. And I don't think that we've seen the last of M&A there as well.
All right, fair enough. All right, let's get into the kind of K-shaped economy and how it's impacting housing. Marry that with demographics we just talked about younger people not buying homes and so forth. And then I want to get into the lower end consumer and the delinquencies that we're seeing, FHA, Ginnie Mae, et cetera, because I think people are overlooking that, in my opinion.
Yeah, I mean, it's clear that we have the haves and have-nots, which is not a new part of the story in our K-shaped economy. But what we are seeing is people really struggling to come up with down payment, and their debt-to-income ratios are extremely elevated. So just getting approved is a challenge for many, forgetting the absolute rate, just getting the down payment, and their debt levels are too high. We have a student loan crisis that is being overlooked by many. For many, the 45 million student loans that are outstanding and those in default, they were not being reported to credit bureaus until the beginning of 25. So now the credit bureaus are finding these people are in fact delinquent and are dinging their credit scores, making it even harder to get approved for a mortgage. And I think that there are young people today that are frowning upon looking at home ownership today. They're getting married later, if at all. If they're having families, at the best case, they're one and done. And so you do see a bit of a secular shift with respect to the idea of home ownership and the American dream. Is it really there? I disagree with that phenomenon. I think that's the only way for many people long-term to create wealth. But, look at the average age of the first-time buyer today. It's 38. And, young people that are graduating college today are really finding it difficult to find jobs. And I think that the more discretionary money that you might have saved in an environment pre-COVID, there's nothing left over after non-discretionary expenses if you're a renter. And a lot of them are doubling up or tripling up or living at home still. So it's very challenging for that young consumer and or that lower income consumer that's already out and about.
So maybe talk about the trends there with single family rentals, multifamily kind of apartment rental rates that you're seeing, because that trend's going to continue. And I know that's a sector that you cover closely.
SFR and multifamily are seeing again, a tale of two geographies, with being the South and Southeast being the most pressured, Southwest, and where single family rental, we just had Imitation Homes and American Homes for Rent report earnings, and new move-in has gone negative. Their renewals are holding up. Occupancies are under pressure. And this has a lot to do with all the build for rent product that's on the market competing. So it's pressuring, the supply is pressuring overall rent rates, which again is better for the consumer, not necessarily for the operator. And the same is still true for multifamily. In fact, the 6 public REITs that reported pretty much across the board disappointed on new move-in rent growth, as well as occupancy. So the only thing going for them is that their turnover is very low as people are staying put. But generally speaking, that's, again, mostly skewed to those markets where supply has been so substantial and they're still working through that supply. While starts have pulled back, we're still seeing them work through that supply that's taking longer.
So as I mentioned in the opening, when the Fed cuts rates, we're going to see a pickup in housing. When the 10-year yields come in, we're going to see a pickup in housing. When mortgage rates come down, we're going to see a pickup in housing. It's really not happening. To your point, it's affordability combined with demographic shifts maybe here and there, but the government keeps talking about pulling out some type of bazooka. They're going to do something. Is it going to be subsidizing mortgages? What is it going to be? What do you expect? What can the U.S. government even do? And we're going to talk about Fannie and Freddie in a minute, but what can the U.S. government do?
Well, first, we're glad to see that the government is focused on housing and trying to come up with what would be a potential solution. However, they admit that, looking at what the alternatives are, much of the issues are at the local market level. So until the federal government really comes after states with a big stick to the governors and say, you guys have to figure out a way to get local markets to be more, builder friendly, overall friendly with respect to the major impediments and a lot of NIMBYism, it's really problematic. I think what they can do and what they're working on is trying to figure out ways to lower the overall cost to borrowers through adjusting loan level pricing adjustments. I know that's something that they're working on. I don't think that would be for a first time buyer. That would more likely be for a second home buyer and or a non-owner occupied buyer that is right now having very onerous loan level pricing adjustments that could be 300 plus basis points. That really isn't necessary, but they don't have a magic wand and a solution. There's talk about them incentivizing builders somehow. And whether that's coming from taxpayers, it's unclear, in my opinion, that there's a lot of tools in the toolbox, again, without getting those local markets somehow motivated to join in to help provide more affordable housing.
I mean, the tariffs and the immigration policies are a little bit counterproductive to getting this going. And so it's almost like they create some of an issue and they want to solve it a little bit. But, again, I think you would agree we need to see rates substantially lower to really cause this. But let's move into the HELOC area, because something you've talked about, Meredith Whitney's talked about a lot, this pent up kind of demand that's out there that people can access equity in their homes. And I don't think it gets enough credit. And maybe, again, it's on the higher end of the K for the K-shaped economy. But are you seeing that start to happen? I know Rocket does that and so forth. Talk about that a little bit.
Before we go there, just to give you one thought on rates, we actually, if you look at housing turnover as a percent of households, if we say 4 million plus divided by the number of households in the United States, call it 130 plus million, that number is at recessionary lows. And in order to get back to what we'd call it a sort of normalized affordability level, rates would have to get to about 4.5%. So we have a ways to go, just to put that in some of a framework for you. As it relates to HELOC, one of the things that I think the administration's contemplating doing is making it easier to do a cash out refi, because it's very difficult for the high LTV borrower that might have significant equity to tap into that equity. Let's say they want to borrow $60,000. It might cost them $35,000 to pay up front for the closing costs and the loan level pricing adjustments. If they can make that less onerous, then people could take out money against their equity and actually pay down debt and be in a better position, really helping families. So if there's a way to do that, which I think is being worked on, that could be pretty helpful. But in terms of HELOCs right now, they're pretty expensive. So really haven't seen them take off. What's been interesting of late is that we're starting to see the builders on their conference calls were talking about the use of ARMs are increasing.
Oh,
because
boy.
we have pretty much a flat yield curve. Yeah, I know. It's memorable moments, but with a flat yield curve, it didn't make any sense to go at the short end versus the long end. But now that the yield curve is steepening, there are many that I think the Journal just had an article earlier this week about the fact that people are pursuing ARMs in order to get monthly payments down by a few $100s. So that's the only major change we've seen with the steepening yield curve.
I mean, that can be potentially painful if the yield curve keeps steepening and the long end causes home prices to go down. I don't have to tell you how that plays out. And Moody's once told us that home prices never go down, but as we've seen, it's going to happen this year, and next year, obviously here. So, all right, let's get into something we talked about in March. It's still evolving, kind of Fannie and Freddie. And whether it happens or not, maybe it will in some form or fashion. But I think the question I asked you back then, and I'm seeing if you're still going to stick with this, which is what will happen to mortgage rates overall? I know the implied guarantee is going to stay and all this stuff. And there's a lot of money to be made here by Wall Street, obviously, on the deal. But give me your thoughts. Can it really help the U.S. consumer or hurt them? And what's this going to look like?
Without being in the room with the people making the decisions on how they'll take the companies public, my understanding, having looked at this really since the, coming out of the GFC, is that, investors that would own the entities are going to demand high returns. So it's like private capital versus public capital. You basically, you can provide, a more affordable offerings, then the private market will demand better returns. So I just don't know how rates wouldn't go higher. But again, I'm not in the room and I don't know how they would execute an IPO without pushing rates higher, but we'll see. I know that they're working on it and they seem very optimistic. So hopefully they have a solution that doesn't result in higher rates. But anyway, that type of capital raise and, assuming a long-term return expectation, you and I both know that the private investment community is not going to, take below average returns.
I want to go back to the U.S. consumer in general, kind of take a step back from housing and kind of what I mentioned before, which is the late payments and delinquencies, which are occurring right now in the kind of lower end. Those trends are pretty staggering. I looked at your cohort that you put up, the 2025, in 6 months, the type of delinquencies you're saying, I think it's 8% or something like that. Why you're not hearing a lot about it at all. And it kind of fits the narrative, like you mentioned before, student loans and things all happening at the same time. Are we ignoring, just take a step back from housing for a second. Are we ignoring this or what?
Well, when we hosted our housing summit in September, we went and did a deep dive on the health of the consumer, and really mortgage delinquencies in total were close to record lows still, even with starting to see elevation with Ginnies that are, early stage delinquencies. So mortgage is not where the problem for the consumer is more prevalent. Auto loans and credit card loans are closer to record levels of delinquency, as is student loan debt. And student loan debt's not even including those that are in forbearance. So when you look at all the kinds of debt, mortgage is actually the one that's the best position, even though I worry about those people that have bought in the last 2 years where home prices are not rising to bail them out, and assuming they have very high debt to income ratios, which we know that Ginnie Mae allows that. Back-end ratios, meaning all their debt as a percent of income could exceed well above 50%, as high as 55%. So I think the consumer is very fragile right now, and we see it in all other credit, with the exception of mortgage. But there are indications that mortgages are going up the wrong way, but still historically very low.
So as you start to write your 2026 outlook overall, forget about home prices being down slightly in 2026, where are you telling your clients to kind of where they should be paying attention? Where is the alpha potentially going to be? Which sector within housing on kind of both sides of the equation? Maybe, I know you're not going to give out particular names individually, but just in general, where do you think there'll be the most opportunity?
Well, I think as rates come down, that's obviously great for refis. So the mortgage market will definitely benefit probably the most. And that's a significant opportunity for people to get their balance sheet in better order. If we really see rates come down enough, it's probably going to hurt the rental market more than the for sale market. And I think that the for sale market on the existing home side could start to see more volume, which is what we're forecasting, because we think that volume is really what's been missing. First time in my lifetime that we've seen in this cycle where you have recessionary volume, but you still have overall home prices rising. And so that divergence, we think, starts to invert, where we get volume and we start to see, home prices decelerating. And that's a good thing. So I think the existing home market could start to see real benefit. I think the builders eventually will. But again, the business models for the builders are such where, they really are kind of stuck to this incentive game. And I think about the consumer today that buys a home, let's say that's $400,000, and they get a mortgage rate buy down to, call it 3.99. Let's say they lose their job. They can't sell it at $400,000. So in some respects, it really creates problems, these mortgage rate buy downs, if we have a recession for those people that are going to wind up selling it upside down because their present value of that home is 15% below list. So that's a fragile side of this where we could see elevated inventories if we start seeing more defaults, especially around consumers in these homes that they use the mortgage rate buy down to buy.
That was my next question, that we are not pricing in any type of recession or slowdown in the economy into these names, I don't think. I mean, I don't know.
No, they're historically, builders, we can argue probably all day about whether they deserve to be re-rated or not. But they're trading, some of them are at elevated multiples, but there's a bunch of them trading at or below book too. So the small caps versus large cap is quite a divergence. But we look at ROE. So if they're trading below book, it's probably because their ROE is lousy. And there's a high correlation between ROE, which is now for some of these guys 5-6% and heading lower. But D.R. Horton's still trading at 2 times book. And so they're still generating a double-digit ROE. So if anything, I'd say that, again, tale of two types of builders, large cap versus small cap.
Do you expect M&A within the housing sector? I mean, I'm sure we're going to see publicly traded housing companies buy private builders in size, especially the ones that don't have the economies of scale. Are you expecting any more M&A within the publicly traded housing by kind of when you look at the regions of what might make sense? No,
not really at this point. I think that, I've asked bankers about that. And the problem is that the privates want more. They think they should trade it. They want to sell a 2 times book. And obviously the builders don't want to pay that much. So I think there's a bit of a standoff. But, if there was an opportunity, let's say a TriPoint or KB Homes, Meritage, those are all trading, at book or lower. They're not willing sellers right now. They believe that they will come out of this, and many of them are buying back stock and even levering up to do so. I mean, KB Homes is levering up to buy back stock, and we've seen that, what can happen with that as well. But, shareholders want them to do something. And if they're pulling back on growth, which is many of them are doing because they don't want to do the incentives and the buy down. So a bit of a tough situation, but they're not willing sellers, which is why I don't think public to public happens.
How involved is private credit in general within your sector? I know you have the small players that obviously they just go to the local banks or loan sharks, so to speak, to build a home and then use that loan lever. But within kind of private building product companies and, importers of things, is it prevalent? And are you seeing any type of bankruptcy action like we're seeing in auto parts, and some will claim that was just fraud, whatever? Are you seeing anything there?
No, we're not at this point. Obviously it's, top of mind now. Some of the the Seaburys and Walker Dunlops and others that have reported that there has been mortgage fraud that was for multifamily specifically. And I think that that's one example of what's happening in the auto industry. We're seeing fraud that occurred during COVID when underwriting standards were relaxed, but we're not seeing it right now in private credit coming up that I'm aware of.
And what's the one thing you think that is the most misunderstood now, bullish or bearish kind of within the sector, where you hear it talked about, but either you disagree? What thing?
I'm kind of like a dog with a bone right now about the optimism around manufactured housing being a solution for affordable, providing affordable shelter. It's a very long or very crowded long by hedge funds. And part of that is because Bill Pulte said he really loves manufactured housing. But when you look at what happens with manufactured housing, forget the quality of the product and the NIMBYism around allowing that to be zoned in. The actual true cost to the consumer after you install it and all the aspects of getting it to go vertical and putting the house on the lot, it's really not that different from an entry-level site builder. So I think that's one thing that's misunderstood. Over time, could they use robotics in factories? Are there going to be ways to reutilize the chassis? Things that the manufactured housing industry is really, really steadfast working on. But as of today, it's really not the solution that many of my clients are calling me about and saying, well, we love manufactured housing. If they can sell a house at $100,000 to the consumer and then the lot costs $150, they're all in for $250, and Horton's selling at $400. Manufactured housing is, substantially better. Like, wait a minute. What about the markup to the consumer that you didn't count, as well as the fact of all the other cost of getting it on the lot? So those are things that one thing I'm focused there, but I'm also focused on, we think the student loan problem is more severe than people are giving it credit.
Is it the expectations of the earnings estimates for the manufactured housing players of kind of the growth rates that are going to be out in 2026, 27, and 28, that people think they've found some demographic unicorn, and you just don't believe it will. There's growth there, but it's not to the extent that you think will be.
Yeah, and I think you said it right. I mean, it's not the unicorn. And coupled with that, if you look at where student loan debt problem is the greatest, it's not with homeowners. It's not with people that can buy a first-time home. It's really people that are renting or buying manufactured housing. And we see that much more in the data. And therefore, I think those potential risks are not being reflected in valuations.
Which of the kind of publicly available NAHB, whatever it might be, the Case-Shiller stuff that's out there, obviously we're missing a lot of government data right now in general, but what do you think is kind of the most accurate? I mean, you do your own surveys in general, but do you think that investors trade off the wrong things, or what would you tell people to kind of watch out there for the signs, other than listen to conference calls, which I always tell people to do if they really want to know what's going on in the space? And obviously subscribe to Zelman Associates, obviously.
Right.
Yeah.
I think that the NAHB data is over long-term correlated, as is the new home census data, to the public companies' results or our results from our surveys. But in the short term, they tend to be very volatile and their samples are small. So I don't really think that either one of those are necessarily indicative of what's going on in the market to the same extent that you'd have it over a longer period. Existing home sales, arguably a bigger sample, it might be really more indicative of what's going on in the market today. But we really don't rely. We utilize that public data, but we rely, again, as you said, on our proprietary surveys to really tell us when you're on the phone. You can't be talking to owners and operators and then aggregating through our survey platform their not only thoughts on trends, but also what are the bigger issues that they face. So we're really fortunate that we have those relationships.
All right, that's a perfect entree. So how do people find you? They go the website that they go to, and you guys cater to every type of investor, I know.
Just Zelman Associates, and certainly Kim at ZelmanAssociates.com is really she's the holder of the keys to the gate. So she's
going to love that you just gave that out. That's really great. So, all right. So do you expect, last thing, so we go into the kind of the Super Bowl season of housing. It's always starts on the Super Bowl, and that's your expectations are for kind of another lackluster kind of spring season as we enter, unless there's some dramatic change in rates or something were to happen?
Yeah, I think that's fair. We'll have a better sense, as you said, in February. We'll actually be we always host a pre-spring selling call with our private builders and realtors, and then we have a post-spring selling season call. So we'll have a good indication and how they're feeling. But going into it, most of them are cautiously optimistic. And many of them that have not been speccing as a strategy, their backlogs going into 26 could be down as much as 30, 40%. And that's not okay with investors, even if they're buying back stock. So I think we're going to also see a ramp back up in specs because they want to be prepared if the market's strong enough. And that's, a decision that they'll be making in the next few weeks of how much they want to start.
Well, that's great. If I can get you back on kind of in March or April, back in that spring sales season, we'd love to have you back in. I'm going to come visit you on the west coast of Florida from the east coast, hopefully, while it's bone-chilling cold in Cleveland. Hopefully you'll get out of there soon. But Ivy, thanks so much for your time and your wisdom, as always.
Appreciate it. Thank you for the opportunity.
Thanks for listening to the On the Tape podcast with Danny Moses. If you like what you heard, please subscribe on either Apple or Spotify to the weekly podcast, and please leave a rating and review, positive only. You can also watch on the On the Tape channel on YouTube and give us a thumbs up there as well.